Developments out of Asia today. Japanese stocks jumped by more than 7% this morning after Prime Minister Shinzo Abe announced that Japan would reduce its corporate tax rate. Meanwhile, China's Ministry of Finance said it would speed up tax reform, boost infrastructure spending and accelerate the use of public-private partnerships to boost growth. Previous spending and growth in China, of course, helping to lift world growth, so that lifted the mood on markets today. Overall, however, there are still some nerves about the health of the Chinese economy. So earlier we caught up with emerging market specialist Martyn Davies, who's attending the World Economic Forum in China, the annual meeting of the new champions. We apologize for the sound quality. He was on the line from Dalian in China. I asked him if Chinese officials there were still being positive.
Well, I think there's been maybe overblown concern about where China is currently in the status of the economy. If we rewind 6 months or so, the fundamentals of the Chinese economy are very, very much the same. Nothing's really changed. The stock market's largely divorced from the growth story, and the growth story continues. And putting this in context, for instance, if we look at when did the last time South Africa get 7% growth, where China is currently, and the answer is 1967. That's 48 years ago. So we have to look at this, in terms of relative to performance, of course. I mean, a 7% growth figure in the current state of the global economy is certainly no mean feat. So there's certainly scope for increased stimulus. The phrase being used here at the World Economic Forum is almost an acupuncture stimulus, very focused. Think real estate, think continued completion of infrastructure projects, which have been on ice for a couple of years. And thirdly is interest rate reductions as well. China's a very large saving pool. Interest rates don't need to be as high as they are. So I think combined, these three measures will start to be pushed forward or liberalized in the coming, maybe announced tomorrow, but coming through in the coming months. And I'm relatively positive towards the continuation of the strong growth Chinese story.
That is good news for us. Should we decouple the craziness on the market from the actual economic fundamentals? Although, just to challenge you, some would say we don't really know what's going on in China, and some have even questioned those growth figures.
Certainly, there's somewhat skepticism to it. I think growth still remains pretty robust, to be honest. There's a long growth runway to go in China. China's, on a per capita basis, is now probably where South Korea was somewhere around the early mid-80s. So there's a long runway to go here. The challenge for China is to really sort of beat the so-called middle-income trap. How does China sort of graduate to a more first-world type economy? And of course, it's a very disparate economy, very rising Gini coefficient, inequality in the cities and rural areas. But China needs to move from, and this is what rebalancing is about, away from this headline, simplistic quantitative figure. We've always looked at China through this quantitative lens, to a more sort of qualitative growth model, and that's what rebalancing is all about.
Rebalancing, however, could affect our own miners here. We've seen the effect on commodities, just this fear about the slowing growth, although you say it's still very good. What can we take out of what's happening right now?
Well, I think there's a couple of things. Firstly, we look at China, look at the commodity story. There's a very negative impact on South Africa. Obviously, neighboring countries. A lead story in the Financial Times today on Zambia, how Zambia has been really dramatically hit with the economy because of the drop in the copper price. Brazil, Indonesia, Western Australia, all pretty much in the same boat here. But I would argue it's not so much a demand story in China we should be looking at, and that's what we're sort of sweating the detail of China's growth. Rather, it's the supply side. There's excess capacity of commodities, overinvestment in recent years because of high commodity prices, and now we're going through a natural process. It's happened in decades previously, where excess capacity is sort of having to be taken out of the system. Mining companies have to cut production. Many will go out of business, I'm afraid. So we're in this very uncertain period.
Final question, because this is something you're interested in. Is there still opportunity in China for South African business?
Yes, there's always opportunity in China, I think. It's not an easy market, of course. Unfortunately, South African firms are very few and far between in this market in terms of a physical investment presence. Maybe a dozen or so companies. We're relatively underrepresented compared to our American, European, or Australian counterparts. But of course, China, I think the demand story in China continues, albeit somewhat subdued compared to what it used to be, but that's normal. China's growing, its maturing economy. China still will remain, I would argue, very relevant for us in Africa, both on the demand side, I think commodities, and the supply side in terms of capital being invested into the continent, into Africa, and of course the significant capital coming in financing infrastructure and the like. So this is the supply and demand side for us, which that China is, and we need to certainly, I think, get to better grips with. We need African economies, companies need to understand China, because clearly it's incredibly important for us, and I think they've only realized this somewhat belatedly.
Apologies again for the sound quality, but worthwhile chatting to Martyn Davies in China.